The annual business confidence survey released this month by the European Chamber for Business in China said that there has been a sharp deterioration in confidence. 64% of the respondents said that it had become more difficult to do business in China over the past year, and that's the highest on record. An Associated Press article quoted the Chamber's president as saying that business confidence has been pretty much the lowest that they have on record, and that there is no expectation that the regulatory environment would improve over the next 5 years. What exactly is happening in China's economy? In 2022, China recorded GDP growth of 3%, far lesser than the 5% that the government had estimated. For the quarter ended March, GDP growth rebounded to about 4.5%, but then again in April and May, there's been a weakening of sorts. In a note, the Rhodium Group said that about 2,900 local government financing vehicles showed a rare decline in overall cash positions, which is actually a challenge to the fiscal support that the economy might need. The group says the current weakness of local government finances prevents Beijing from using fiscal policy to support the economy. In fact, this is the primary reason that there has been no meaningful fiscal support for China's recovery so far this year. Public calls for Beijing's assistance from a couple of provincial governments mark the beginning of the end of local governments' rapid debt accumulation. Gui Yang's government claimed in a summary of work in 2022 that a default could occur at any time, while Hohhot cited heavy debt burdens and interest costs, claiming they had limited capacity to manage debt. These cries for help will likely be followed by those from other provinces, the group says. Because both retail consumption and investments have declined, the Chinese government has opted for a couple of interest rate cuts. But the quantum of cuts has been far lesser than originally anticipated by investors. Because the dangers of cutting rates too much is twofold. One, if there's too much of a differential between rates in one country and in the rest of the world, then investors pull out funds from that country for deployment in economies that offer better returns. The rest of the world has actually been increasing the rates, including India, and then pausing for a while to see how the growth versus inflation equation progresses. Two, lower interest rates could mean easy money, which in turn could mean inflated asset prices, especially in the context of real estate. Easy money could also mean local governments, provincial governments, having access to cash, and then they end up building subways and roads, which typically generate poorer returns. In the recent past, the Chinese government has been acting on both fronts, capping local government debt as well as trying to temper the property bubble. In a commentary put out by Reuters, a writer actually cites Japan's lost decade with poor economic growth as a prospect that China faces, thanks to depressed consumption and investment. Not acting to revive the economy is not an option. So, the government is mulling options such as issuing special treasury bonds outside of its budget, amounting to $140 billion, according to a Wall Street Journal report of June 15th. So far, investors have been disappointed by the quantum of stimulus that the Chinese government has doled out. Equity markets have slumped last week, even as the yuan dropped to its weakest since November. A Bloomberg report from last week points out that an analysis by Morgan Stanley showed that fund managers have remained net sellers of China's growth and tech stocks in May and June. Hedge funds have been adding bearish bets as their outstanding short positions jumped 32% in June, indicating a declining confidence in the economy. The report points out that JP Morgan Chase, UBS Group, Standard Chartered, and Citigroup have recently trimmed their 2023 gross domestic product growth for China forecasts to 5.5% or lower as official figures for exports and credit expansion to retail sales undershot expectations. In other words, if both retail consumers and investors remain skeptical about economic prospects, then interest rate reductions or tax breaks to those buying clean cars may not make much of a difference. Add to all this, China's posturing in obvious support of Russia in the latter's war in Ukraine has also not earned our Asian neighbor any brownie points of the West. Like the US, Europe too, in March, acted against Chinese interests on the semiconductor front. The Netherlands, which hosts ASML Holding, a key supplier to the global semiconductor industry, had put in place curbs on overseas sales of chip technology. China is now trying to woo back Western interests, as is evident from news of the Chinese economic planner trying to get BMW and Airbus to invest in China. To round off the discussion, here's what the International Monetary Fund estimates. With a shrinking labor force and diminishing returns to capital investment, growth in the coming years will depend on boosting declining productivity growth in China. Without reforms, the fund estimates China's growth to fall below 4% over the next 5 years. But it may not be in anyone's interest to rejoice over China's decline, because the IMF points out that for every 1 percentage point growth for China, the rest of the world actually grows 0.3 percentage points. And here's an interesting factoid before we sign off. A note by the World Economic Forum in 2016 showed that China was the world's largest economy in 1820, and now it is the second largest. It says, at the outset of the reforms in 1978, China was poor. It had a GDP per capita level similar to Zambia, lower than half of the Asian average, and lower than 2/3 of the African average. China experienced an average GDP growth of close to 10% per year until 2014, raising per capita GDP almost 49-fold from $155 in 1978 to $7,590 in 2014, lifting 800 million people out of poverty, an unparalleled achievement. Do you think India can draw any lessons from China's phenomenal growth over the past few decades and its recent decline? Tell us in the comment section below. And if you're watching this on YouTube, do not forget to like, share, and subscribe. Till we meet again, have a lovely week ahead.